All right, we are now streaming live.
Okay. Pursuant to recently adopted amendments to the Illinois Open Meetings Act included in Public Act 1010640, public bodies may, in certain circumstances, hold entirely virtual public meetings without a quorum physically present in any one location. On March 17th, 2020, President Levin issued a declaration of emergency to address the health threat posed by the COVID-19 pandemic. On June 15th, 2020, President Levin executed a written determination that given the ongoing emergency associated with the COVID-19 pandemic, in-person meetings of the Board of Trustees are not practical or prudent. On April 5th, 2021, Governor Pritzker issued his most recent disaster proclamation in Executive Order 2021-06 that declared in-person attendance at public meetings of more than 10 people at the regular public meeting location to be infeasible. In accordance with the above actions, in-person meetings of the Finance Committee are not practical or prudent at this time and until further notice. This meeting is being conducted virtually with members participating through the Zoom webinar platform. Village Manager Corrali is present in the Village Hall as required by the Open Meetings Act. Can we have a roll call?
Certainly. Trustee Vree.
Here.
Trustee Miller.
Here.
Trustee Rubin.
Here.
And for the record, Trustee Hallwax is also joining us this evening.
Thank you. In accordance with the supplemental rule the board approved on April 16th, 2020, here's how public comment will be taken at this meeting. The email address and telephone number designated for public comment for this meeting were published with the meeting agenda. In a moment, I will ask Assistant to the Village Manager, Jordan Lester, to read the public comments that were submitted prior to the meeting. If anyone would like to submit a public comment during the meeting, please email your comment to glencoemeeting@villageofglencoe.org. Comments submitted during the meeting may be read at the end of the meeting. Written comments should be limited to 400 words. Assistant to the Village Manager Lester, are there any comments?
No, Trustee Vree, we did not receive any public comment tonight.
Okay, thanks. Okay, can we have a motion to approve the minutes from our last meeting?
So moved. Second. Well, do what you want with it.
We got it. We're all good.
Can we have a roll call, Phil?
Trustee Vree.
Yes.
Trustee Miller.
Yes.
Trustee Rubin.
Yes.
Okay, so we can move on into the monthly review of the financial reports. Nikki, if you want to walk us through.
Sure. Okay. Here we go. Okay, so just a brief update on tonight's agenda. We will start with the March Treasurer's Report, which is included in your packet. Go through some of the highlights, including the Glencoe Golf Club highlights. And then we will move on to the Community Investment Program updates. And then we also have two of our representatives from PMA Asset Management that have joined us and will be providing an update on the village's investment portfolio. And then lastly, we'll be talking a little bit about the American Rescue Act funding that will be heading the village's way shortly. Okay, so just going through, we are 3 months into the year already, but we're still a little early to see much in the way of trends. A couple of the highlights from the general fund being 25% of the way through the year. Probably the biggest story that we would share tonight is related to property taxes. We are running lower than this time last year, even if we are at about 41% of budget. The difference is about $650,000 compared this time last year. And it's largely due to the delay in the county's penalty deadline. When you take into consideration when the installments would have been due and now they've been moved to May 3rd, we were anticipating about $1 million in delay of revenue. Now this will impact our cash flow a little bit, but it will not impact our operations. So from a standpoint of earning interest rates aren't very high right now, but we will see that delay in cash, but it will not impact our ability to make payroll and pay our bills. So we are right on target with what we were expecting. So we're about $1 million shy in terms of revenue delay. So we do still anticipate all of that money being collected, and that is reflected in the projections in the general fund. And if you recall, this time last year, the county did extend their property tax due date, but not until the second installment. So that's really the difference between this year versus last year this time around. From an income tax standpoint, we are still running higher than budget, higher than last year. We do expect this to be somewhat short-lived, as the state has really announced that they will be targeting the local distributive fund as part of their state fiscal year 2022 deliberations again. So they've already indicated that we can see a potential decline as much as 10% in that revenue. So that's something we'll watch very closely, but it wouldn't affect us until later this year. Sales taxes are still running lower than prior year. The distribution that we received this month was for December sales, but we are at 33% of budget. So we're not too far off from what we had anticipated during budget time. And our permit revenue is actually doing very well. We'll talk about this in just a moment, but we did have some strong performance with 7 new building permits this month alone. So we're performing very strong in that area. Our utility tax continues to perform higher than prior year. That's really rebounded from where we saw the year start off, largely related to weather conditions. And then lastly, we've incorporated the places for eating tax in the report. We're very pleased with where this is at. The figure that you see in the report and on the screen reflects only 2 months of revenue. There is a month delay from the time in which the sales are remitted or the sales occur, and then when they're remitted to the village. So we are running slightly higher than what we would have anticipated in terms of budget at 27% of revenue for the year, with only 2 months of revenue reflected. In the water fund, our total revenue is slightly lower than last year. This was because last year we had some one-time emergency usage from one of our larger water customers that obviously did not happen this year. Even excluding that, the revenues continue to perform a little bit higher on a volumetric and fixed charge basis. So the emergency use is in a different account, so it's not reflected here. This is largely due to the increase in water rates and also the new meters that we have out there that are registering the new use or the usage that may not have been registering with some of our older technology. In terms of cash flow projections, I know we just mentioned sales taxes. We do have the figure for January sales, the distribution that we will be receiving this month. We did see a little dip in the month of February. That was for November sales last year. And then their sales taxes are coming back strong in April. So this represents January sales. It's a 20% increase over this time last year. So we really are starting to see this revenue stabilize over time from that deep low that we saw last May, which was May sales for the distribution in August. Use taxes are at 27% of budget. We have not seen any change in this revenue yet from the point of sale, point of distribution legislation that changed on January 1st. We will eventually start to see that shift where our sales taxes will begin to go up and use taxes will start to go down. So we'll continue to monitor that and certainly report that as soon as that starts to shift. Our PPRT, personal property replacement tax, is at 48% of budget, and we just received another $33,000 that arrived today. As you may recall from looking at budget projections, the distribution of this revenue is somewhat erratic, but we do receive it directly from the state. We had indications from the Illinois Municipal League that this revenue would decline significantly this year. So far, knock on wood, we've been very fortunate and we have not seen that yet. So this is something that we'll continue to watch as well as the state progresses in their budget negotiations. And then lastly, the projected impact for the year is actually a $214,000 surplus. When looking at what we budgeted for revenue and what we are projecting to receive this year, those figures have been adjusted for what we have received through the month of March. Again, it is a little early. We're only through the first quarter of the year. A lot can happen between now and the end of the year, but that is what we are projecting as of today. So at this point, I'm happy to answer any questions on the treasurer's report. Okay, seeing none, I am going to hand this over to Stella to provide the golf club financial update.
Thank you, Nikki. So March turned out to be very good for the golf course. Although we had so much snow on the ground, it had a nice slow melt and we were able to open up quite early in the golf business. We had over 1,000 rounds that were played, so we exceeded our budget by 789 rounds. Revenues were almost 3 times over budget. Our expenses were 40% below budget. Some of the capital projects that we had plans, we weren't able to take care of because there was that much snow at the beginning of the month and the ground was saturated, so we couldn't get any large equipment out there. Friends of the Glencoe Golf Club is going along very well. We're making some very good progress. We have a meeting planned for this Friday where we're going to review naming for the facility, different options of naming and values that the Friends Board will decide and deliberate and come up with a plan on. We're also going to review some of the top prospects that we have designated through our cultivating and capacity analysis reports from our fundraiser. And we're also going to review the civic case for support that's going to be used as a marketing tool. So that is what has been happening in March, and happy to answer any questions.
Stella, it's Joe. I have a quick question. Was that
Sure.
1.54% revenue above budget? Is that right?
That's right.
So,
Yeah, we budgeted 26 and we brought in 68.
so I guess, I mean, the 1,000 rounds were played in April, not necessarily March, right? Because that
No, that's March.
would have been higher than if we beat
I
it
think
by
it's supposed to be 154%.
Yeah.
Not 1.54,
Oh,
right?
there's the point got in there. Yeah,
Yeah, okay. That's what I figured.
Yeah.
Okay, great, thanks.
sure. Thanks for your point.
It went in the right direction, in other words.
Yeah, that's a good one to have.
Yes.
Okay, any other questions for Stella? Okay, moving on. I'm going to hand this over to Assistant Finance Director Joseph for our CIP update.
Thank you, Nikki, and good evening. We have one CIP project to highlight for the month of April. On Thursday evening's agenda for your consideration is a contract for phase 2 of the engineering design for the Green Bay Trail Crossing Improvement Project. This contract is in the amount of $33,910. Moving to the CIP quarterly report on the next slide, thank you. We have a couple of projects that we had initially indicated would be on the April Village Board agenda for your consideration. However, we have had to adjust those timeframes slightly, including when we anticipate the funds to be expended. That includes the projects that are kind of highlighted here in a I believe that's a blue shade on the screen. The first one is the sanitary sewer improvements. The contract award for this project will be on the May Village Board meeting agenda for your consideration. And we've kind of pushed off a little bit the driving range tee expansion at the golf course. That is tentatively scheduled for September. So at this time, happy to answer any questions you may have on the CIP.
I can just add one point to Denise's comments relative to the Green Bay Trail crossing improvements. Just as a note to the committee, we have applied for grant funding to pay for the improvement itself. We had an interview with Cook County about a week and a half ago, talking through this project as part of the Invest in Cook program that they run, and we've also applied to CMAP for funds to help defray this project cost. So just wanted to add that point. We're pretty hopeful that those grant funds are going to come through.
One quick question about the crossing. So is the park district paying for any of it, or is it all on the village?
And Dave, you can correct me if I'm wrong. This is all village. This exists on all village property. Primarily, it relates to the approach on both sides of Hazel, and it will ultimately interact with the Park District's project. Dave, I can't recall, did we do a joint grant application with them on this?
We did not, other than just recognizing they were a parallel partner, and the connection between the Caulk Park work that's going to break ground this year, and the work that happened in north of Park Avenue last year, and this trail, this link in the trail.
Okay, thanks.
Any other questions? Okay, moving on. All right, so our next item on the agenda is review and discussion of the investment portfolio. As the committee probably recalls, in 2019, the village engaged PMA Asset Management to manage approximately $5 million in cash reserves. And as part of this arrangement, PMA is to provide regular updates to the committee and or the village board. So we will be doing that tonight. That'll be part A of our presentation this evening. And as I mentioned earlier, we do have Brian Hextall and Eric Stolz joining us from PMA. And then the second part of the presentation this evening is going to be discussing an additional money market option that's available through PMA. We're very fortunate to have the community's support for the most recent bond referendum that went before voters earlier this month. And as part of that, we do expect to see bond proceeds as early as the month of July. And we will need a safe vehicle to place those in. Typically, the village has used a local government investment pool that we have been participating in for quite some time to essentially invest those bond proceeds until they can be spent. Recently, that local government investment pool announced that they no longer will produce arbitrage reporting, which is a fairly key piece to the regulatory compliance that we need to abide by when we issue bonds. So we did approach PMA for some alternatives to offer when we do close on these bond issues. So we'll be talking a little bit about that as well. So at this point, I'd like to turn it over to Brian and Eric for your presentation. You should be able to share your screen. And I will stop sharing mine. Here we go.
Perfect. All right. Are you seeing that, everybody? Coming up, that's always one thing. It's a little hard to tell on my end is, can everybody see the screen or not? But, well, very good to be talking to you, I guess, this evening. Certainly good to catch up on the portfolio, as there's never a shortage of things going on in the economy and in the markets. But certainly, I think you're going to be pleased with the portfolio's performance over the past several months. And, as I wrap up my remarks, we'll certainly switch gears and Eric will speak on the second half, who heads up our institutional sales here in Illinois with some discussion on the second item that Nikki described there with another short-term investment offering. So with that said, I think everybody, for the most part, everybody, there might be a new face on here though, just a quick reminder of who PMA is. We are 3 related companies serving almost exclusively the public sector. So almost all of our clients are public entities, very much like the village of Glencoe. Our PMA Asset Management that I represent is our registered investment advisor. Together we have it's actually over 150 employees now. We're responsible for almost $30 billion in total of client assets. And just about 14 billion of those are assets under management. So discretionary investment relationships like we have with the village of Glencoe. So definitely very proud of what we do for public entities, and again, very happy to be serving the village of Glencoe. As a company focused on public entities, we're very in tune with the GFOA's recommendation of safety, liquidity, and then yield. That is really built into the foundation of everything that PMA does. And that starts with research. It includes layers of risk management, most importantly, building diversified investment portfolios. And when we put all this together, we expect to generate really strong returns for our clients. We've got a great team of professionals that are working hard on your account every day. Our senior leaders average 25 years of experience, and you can see we're led by our Chief Investment Officer, John Huber, part of the service team. We have a number of folks on the credit team, so they're focused on sectors like corporates as well as municipal securities. Our rates team is focused on treasuries, government agencies, agency mortgage-backed securities. We also have an equity team and a number of traders supporting our work effort as well. So, and I have a dog also, so I don't know if you can hear him in the background, but we were talking about that before. He's joined me. But with that said, really want to turn over to the economy. As I mentioned, never a shortage of things going on, and one of the real, from a macro level, thinking about US GDP is the broadest measure of growth. And we saw a lot of big percentage numbers last year, swings of plus 20% GDP and minus 20% or 30% GDP. I mean, these are types of numbers that we never have seen before, certainly not in our lifetimes. So just kind of tracking on that, what does that mean in dollar terms? Where I've got my cursor here, this is the fourth quarter of 2019, and just drawing a straight line across. So first quarter, second quarter, third quarter, fourth quarter of 2019, you can see of 2020 rather, you can see we're not even back to the level of aggregate dollars of GDP growth as we were at in the fourth quarter of 2019. With the projected growth here in green in the first and second quarter, you can see that economists kind of expect us to make that full recovery in the second quarter of this year. So that's an 18-month time period between really when this down turn began until the time we recover. And if we kind of look at that trend growth line in gray, even with the next 4 quarters being projected at very high growths, it still doesn't get us back to that, that level of demand and of total gross domestic product that we were kind of on course to be. The bottom half of the chart here shows the various contributors. The things I'd point out here are that, and I think we talked about this last time, housing really was an area that helped lift us out of, the worst part of this recession. You can see the really strong growth year over year. Business investment not off as much as personal spending. That weakness in personal spending pretty pronounced. And of course, on the government side, state and local governments really feeling the squeeze here as well, and detracting from from overall growth as well. As we think about, the consumer and how they're spending money, obviously jobs are a huge part of that. And while the improvement has been significant, we still have a headline unemployment number of 6% in March. And what the number that's really been getting a lot of attention lately is the underemployment rate represented by this darkest blue line. And that was 10.7% in March. Another way of thinking about the labor market is how many people are in it. And you can see that there's a lot of people who actually exited the labor market. And there's a certain way that the government agencies that put together these numbers measure these things, and it has to do with how long it's been since you've last searched for a job. But you can see there's a lot of people who just have become discouraged is the term that's used, and are no longer looking for a job. And similarly, you can also see that in the labor force participation rate, which also dropped significantly. It saw some spike, but you can see that's really leveled off, both in terms of the labor force. So people who really leave the job market, it's difficult to come back. And this speaks a lot to, I think, why we see the Federal Reserve, as well as Congress and the White House, still providing very supportive measures, recognizing that we've got these unemployment levels that really haven't been this high since 2014, 2015 type range, when we were still working our way out of the financial crisis. Turning to the next slide, where are market interest rates? So I call this the eye test here on colors, but the light blue line here towards the top is where interest rates are at today. And this is the Treasury yield curve going from 1 month all the way out to 30 years. The gray line is where interest rates were at a year ago. You can see on the short end, interest rates have actually moved down even lower. So as we think about those overnight savings accounts or money market funds, since a year ago, rates fell even further. As you get out beyond 3 years, interest rates have actually moved up a little bit. The dark blue line here is where rates were at just 1 quarter ago in December. And, similar story there, that the curve is definitely steepened. 3-year, 5-year, 7-year rates all much higher. And as bond investors, what that really tells us is 2 things. It's the market sees stronger growth potential in the years ahead, and it also sees a potentially higher inflation in the years ahead. Our view on that inflation, by the way, is that we don't believe it is going to get out of hand, as some have worried, and we've seen some of the financial and popular press talk quite a bit about inflation over the past few years. We certainly think it's going to rise, but we don't see anything near a repeat of the 70s style hyperinflation that was experienced during that decade and into the early 80s. This green line is where interest rates are projected to be a year from now. So that increase in rates, particularly out the curve, is definitely projected. This is also projecting the potential for a rate rise in very short-term rates. We're a little bit suspect that that's actually going to happen in the next 12 months here. But, rates trending up is definitely the story. And as bond investors, it's a good news, bad news story. And the bad news isn't so bad, but the good news is that we have that ability to invest into what's a higher interest rate environment. So generally, investing at higher rates means more income for the village. On a mark-to-market basis, though, many of you are probably also aware that as interest rates move up, bond prices do move down. So from a purely mark-to-market perspective, and we'll see this in the portfolio here over the quarter, as interest rates have moved up, there has been some downward pressure on prices. And that's really just driven by these macro factors of the entire bond market. Just a couple thoughts on our outlook. All of the stimulus, both from the Federal Reserve as well as the White House and Congress, definitely resulted in some market complacency, and that's really pushed asset prices up. So whether you're thinking about equities, the stock market, or you're thinking about bonds, prices are definitely high right now. And we definitely still recognize that there are risks in the market. So, security selection and really thoughtful consideration of each bond that's purchased is really very important. And those risks are things we talked about last time in terms of changes in consumer behavior. And while we didn't write the pandemic, because I think everyone's getting tired of seeing pandemic on a slide, I think we do all need to recognize, though, that there are still risks around new strains of the virus. There's risks around the rate at which folks get vaccinated, and the market's really pricing in a lot of very, very positive news right now. So to the extent that any of that doesn't quite live up to expectations, you could see some reversal of that inflated prices that I was just talking about. Again, very supportive Fed. They recognize that there's risks. And again, that's why we don't think that they're going to be raising rates anytime in the next year. They're telling the market that they don't expect to raise rates until sometime after 2023. So we're still 3 years away from a rate hike, at least, according to the Federal Reserve. Lots of money being pumped into the markets. I mentioned those really short-term interest rates moving down, definitely pressure money market type funds, overnight bank deposits. There's just not very much rate to be found right now. All of this money sitting in banks' hands is really keeping interest rates very, very low. And then finally, we certainly are thinking about the debt that's been taken on both at the public and private sectors. Certainly there are some risks here, but again, my point earlier, we really don't see, a high risk of very high inflation. That said, we're always very thoughtful about the portfolio. We're diversified. We're doing our best to make sure that, the Village's portfolio is very well positioned in the, event that things don't play out in the most positive way that's maybe being priced into the markets currently.
Hey, Brian, I have
So
a quick
yes,
question.
please.
Yeah, and point 2 on that slide, you said equities and bonds are high. I guess I'm not following. If I see rates pushing higher and bond prices getting hammered, I guess I'm not following what you mean by bond prices are high.
Yeah, so very recently we've seen some reversal in that, but I would say overall yields, particularly at the shorter end, are still pretty low by historic standards. And we're also not seeing very much spread in markets. So let me go back to.
Yeah, I was going to ask about spread, and particularly in the securities that we have, because I without having the portfolio in front of me, I'm just curious as to your comments on that.
Yeah, no, that's a very good. And I was definitely building towards that. So yeah, we've seen some steepening in yields here. I mean, we're still talking about rates at the 5-year part of, a little over 1%. The 10-year today, I think at a 167 or something like that. I mean, historically speaking, that's still really, really low interest rates, and low rates mean high prices. And the thing on top of that is that we're not seeing very much spread. So as we think about municipal securities, corporate securities, even to some extent agency mortgage-backed securities, you expect those securities to trade at some spread or additional yield on top of that Treasury security. And the market is very hungry for yield right now. So the participants are gobbling it up in the real technical term there, and keeping those spreads pretty low. And again, the price is fairly high.
Thank
But
you.
very good question. Yeah. And again, it is certainly, to your point, it's certainly good to see interest rates moving up. I mean, it's trying to invest in these super low rate environments is a difficult endeavor, and certainly not one that leads to the kind of income that we'd all like to be generating in the portfolio. So here is the Village's portfolio. Once again, a very well diversified, very high quality, very liquid group of securities. And kind of working our way around the chart here, we've got that 11% allocation to US Treasury securities, a small amount of corporate securities. Biggest piece of the portfolio is the agency mortgage-backed securities, which I know we've talked quite a bit about with this group. Again, we're focused mostly on that commercial mortgage-backed securities. These are apartment loans. We like this sector for 2 reasons. First, credit quality is super high. You have Fannie Mae, Freddie Mac standing behind these securities. Just like if we buy just a regular government agency security, which we also have quite a bit of 23%. It's the same credit quality. The difference is mortgage backs have a little more interest rate risk. We like these apartment loans though, because there's a prepayment penalty on the apartment owner to refinance. So it makes that less likely. We still pick up a little bit more yield as there's some complexity basically in the structure of these securities. You really need to look at each of them one at a time and understand exactly what you're buying, just in terms of the diversification within the underlying apartment buildings that or apartment loans technically that make up those securities. But again, very, very high quality, a big part of the market, very liquid. And then, rounding out our pie chart here are those taxable municipal securities, a nice piece of the portfolio. We do show the yields in each one of these sectors. Now, there's, some of these are a little bit longer. Remember, duration is basically time to maturity. But you can kind of get a sense of where yields are at across each of these. And you know what? I noticed this is a day of decimal point errors here. I have a 0.056. That should be 0.56. No zero there. So, municipals picking up just about 6 basis points for a similar time to maturity of the portfolio over corporates. Again, things are pretty tight as we're thinking about these types of yields. So we're very thoughtful about it, and there's a reason that we have a pretty limited corporate exposure in the portfolio. It's that we just don't feel as though we're really being well compensated for that when you can buy an agency mortgage-backed security, shorter duration, higher yield, agency credit quality behind it. That's just a lot more attractive to us in the current market. Portfolio all in, we're always very trying to be very transparent and about how we're comparing to our benchmark. That is, the portfolio has a yield overall of about 60 basis points compared to the benchmark of about 30 basis points. So a 28 basis point yield advantage over that benchmark. Again, we're doing that with the sector allocation that we show here. We're doing that with a time to maturity that's very similar to the benchmark, and with average credit quality that's also extremely strong. Any questions on the portfolio itself here? All right. Diversification, not only by security type and by sector, but also by time to maturity. We've got a 1 to 5 year strategy. Some securities here inside of a year, the biggest part 1 to 2 years, laddered out to 5. Small amount, about 6% of securities go out beyond that 5 year mark, but very much so in line with the benchmark. And again, nice diversification and a strong opportunity to reinvest. As you can see, inside, in the next 2 years, a lot of this portfolio will be maturing, not to mention the cash flow that's generated through the coupons generated, as well as other principal pay downs. So, excuse me. So yeah, I mean, really important as we think about changes in interest rates, how the portfolio is structured in terms of time to maturity.
I just have a quick question as far as the maturity schedule.
Yes.
How much freedom do you guys have to adjust, call it average maturity?
Yeah, it's I'll kind of answer that 2 ways. On one hand, we do have discretion over the portfolio, so it's considerable in that regard. But on the other hand, we are managing to this 1 to 5 year benchmark. We realize that's the need of the village. That sort of a time frame aligns with the needs and objectives as we think about reserves.
Is that in the policy statement, the investment policy statement, or is it in the mandate?
I don't believe that's actually in the policy statement, but it's in what we would refer to as our mandate for this document. So we've kind of set up a plan. We've established a benchmark. So we're going to continue to target that 2.8. Now, there may be times when we think it makes sense to be slightly longer. There may be times when we think it makes sense to be slightly shorter, but duration's a big lever. I think as I'm speaking with clients, oftentimes the thought is that, well, allocation between these different sectors is really where we're going to get our value. Yes, to some extent, but investing longer term or investing shorter term is a huge driver on total returns. Where those market interest rates are at, certainly sector spreads make a difference, but where the market is at in terms of Treasury and how it's moving up or down. That's why I'm almost every time I meet with you, I'm going to show you a chart that looks a lot like this, is because it's a giant driver of total return in the market. And, we don't want to stray too far from that because we want to stay true to the investment plan that we've put in place alongside the finance department, as well as this committee and the board.
Yeah, I wouldn't be comfortable if we could go out 10 years or something like that.
No, that is not the case.
It does say in our investment policy that the duration cannot exceed 5 years and the maturity of corporate obligations may not exceed 3 years.
It can't exceed 5 in average duration or in any duration. Obviously, we have some duration past 5, so you're probably talking average, Nikki?
I think it's average. Let me see.
I would think that
Reserve this is specific to reserve or capital improvement project monies, which would be this.
Which is this,
I would assume that given where we are and what we're going through, safety is very critical. So 5 years is actually a long period of time right now.
I would agree with Larry.
Yeah, no, absolutely. And that's why I always emphasize that, we talk about a 1 to 5 year plan, you kind of hear 1 and 5, right? But I always want to point out there's a lot in the middle here. So there's plenty of investments coming due, all between 1 and 5 years.
Yep, that I saw on the graph.
Hey, Brian, it's Joe again. I have a quick question. Do you have anything that shows both the duration, say, like this graph and then the one before by sector compared to the benchmark? So to see what are your active bets against the benchmark, or where are you choosing to take tracking error?
Yeah, no, that's an excellent question. And I can run that report on either one of those, actually. You're going to find that on duration, we tend to be very, very tight. So we're going to be close there. On the sector allocation, it's purely a Treasury agency benchmark that we have in place, just representative of high quality. So to the extent that we have any municipal or corporate exposure, that's going to be outside of the benchmark.
Okay.
That's a conversation that comes up many, many times with finance committees and boards. It's as we think about Illinois state statute and the various requirements that are in place, it's really hard to find a benchmark that matches up real well with that outside of a Treasury and agency. So what I always point out is that we expect to be generating a yield advantage over our benchmark. We expect to be generating, on this next slide, returns. And you can see that our yield exceeds the benchmark by about 30 basis points, and our total return since inception is also around 30. So, that's to be anticipated because we do have some exposure outside of the benchmark there on sector.
In mortgage-backed securities, how much do we have in securities where the mortgage is on ownership of property in major cities, such as office buildings or apartment buildings or condos in major cities, which are at such high risk right now?
Yeah, absolutely. So we have zero exposure to what I would call commercial properties. The exposure is in apartment loans. These tend not to be giant high-rise projects. Those get kind of financed in the debt markets separately, more kind of in a private space. This tends to be more your suburban sort of, 5-story apartment building. I'm not going to say it's that exclusively, and we could certainly dig into that detail for you. But yeah, these generally are not going to be big high-rise apartment buildings.
Yeah, I'd like to just see an analysis on our mortgage-backed securities, where the mortgages are and what they are, and their duration.
Yeah, we will get that for you. MBS. Okay. I've got that written down. So anything else? So returns here, since inception, again, apologies, that got cut off here too. 3.12% versus 2.81 for our index. The trailing year also very, very strong, but you can see here on a year-to-date basis basically through the month of March, total return in the portfolio of negative 0.24 basis points. Index was down further at 0.4. So we did generate positive excess returns over our benchmark on a year-to-date basis here. And again, since inception, even including that, bit of a downturn in prices here during the first quarter, we still are up, over here on a, since inception basis. So I think we're, doing very well here in generating these types of returns. And obviously what's been a fairly challenging, 15, 16, 17 months here since we got started, but performance has been quite strong and really reflecting the high quality nature of the Village's portfolio. That wraps up my remarks. Before I turn it over to Nikki and Eric, any final questions here?
For me, thanks.
All right, thank you.
Thank you.
Thanks, Brian. As we mentioned earlier, as we move into the next phase of this presentation, I will turn it over to Eric, who's going to talk a little bit about an alternative option for the Village in terms of investing its bond proceeds. We will be bringing some more information before the Finance Committee in the coming months in terms of the size of the issue and the timetable of that, but we wanted to talk about this first so we can plan ahead a little bit as we kick off the process of the bond issue. So Eric, if you'd like to talk a little bit about the iPrime option, I'll hand it over to you.
Of course. Thank you, Nikki. Again, just a short couple slides here to kind of give you an introduction of iPrime and the fund that we run here for our local government investment clients in Illinois. So this slide right here is really nice because it kind of gives you a visual on how we like to think of our clients and how they ladder out their investment portfolio. So as you see on the top right-hand section there, we have that box checked off for you, right? Because this is what we were just talking about with Brian for the last 20 minutes or so, was that long-term portion of the Village's portfolio and how we are going about managing those long-term reserves. We're really kind of thinking about them almost in perpetuity, right? Those are reserves that you're not planning on touching for a long time, and we have the ability to extend out the yield curve further, diversify the asset allocation, and really gain you some strong returns over time. What we've been talking about with Nikki is about how we can kind of bring together a more cohesive plan for the Village, and that's where the iPrime fund really comes into play. So again, the iPrime fund, it's a local government investment pool. It's allowable under Illinois state statute. It's registered with the state and it's run by PMA. So again, the group that Brian works under, PMA Asset Management, we talked about the 3 PMA companies. PMA Asset Management is the registered investment advisor that actually manages the day-to-day operation of the iPrime series. So that's really the nice thing too, is that it's being run in-house by a registered investment advisor. So registered with the SEC, registered with FINRA, goes through all the regimen to make sure that it's audited and meets all those requirements they're very stringent with those organizations. Again, PMA as the asset manager, its emphasis is on the safety of principal for its investors. So again, this is a liquid pool. But again, what's really nice about it too is that it has the liquid option for our clients, but there's also a fixed rate component as well. So when we're looking to hit those kind of short, intermediate term investments, kind of that overnight deposit to that 0 to 12 month term, you have the opportunity to use this pool for, again, overnight liquidity, but then also you can ladder out a portfolio using CDs, government agencies, munis that you select and that are selected by the village. Again, the nice thing about this tool as well is that we have our own proprietary reporting in place to track the arbitrage for the bond issues. So that's a component that almost all of our competitors do not offer. And like Nikki had mentioned, I met recently kind of took that away, and they're not going to be offering that anymore. So again, we have our proprietary tracking in place where we help track the drawdowns for the bond proceeds and make sure that you're meeting those regulatory requirements. Build out a projection for you so you can see how you will be receiving income payments as you ladder out a bond portfolio that matches the drawdown. And again, it puts together a nice report for you should the IRS ever come knocking on your door to make sure that you're filling those regulatory requirements. Again, so liquidity vehicle, the yields on the fund compare favorably with national indices. Again, Brian was talking about it. Yields are low in the overnight markets right now. We know that. But over time, because this is a pool that is invested on a daily basis, it's managed on a daily basis, it's going to track what the market's doing, especially because, again, that's controlled primarily by the Fed because it's such a short-term pool. But again, we really feel like this is a great opportunity for the village to also utilize the iPrime fund that we manage, because it'll help us create a more cohesive and integrated approach that utilizes PMA services from top to bottom, from the long end of the curve to the very short end. And again, like we've said before, this is our bread and butter. Public funds is what we do. All of our products and services are really catered to this market, and everything kind of encompasses the Illinois public fund statute. So we really feel like this is another opportunity to partner with Nikki, and again, to be just another extension of your staff when it comes to providing our services. So that's really, those are really the points that I wanted to make. I'm not sure if anyone had any questions about this particular product, or kind of how we are thinking about building out the investment plan further, and kind of how we think about it.
I guess, so is this a money market alternative effectively? Because, I mean, these are fairly, while it's you put it in this middle bucket, money's getting spent over a pretty short period of time. And, I don't think we'd want to take any interest rate risk on this. So, I mean, you can see just in short-term returns this year with negative returns, that's for the upside of, 15 basis points, I'm not sure.
So the nice thing about, the nice thing about this pool is, so it is a money market pool, but think of it as if you have your own personal brokerage account, you have the money market sweep, which is essentially what iPrime is. It's an overnight money market pool, but it also gives you access to the fixed term deposits. So we have an extensive CD program that utilizes banks across the entire country. And then you also get access to the entire fixed rate market, or the bond market, that you guys are allowed to invest in. So the really nice thing is, if you wanted to build out more of a stable fixed term ladder with your portfolio, where you're not seeing those market fluctuations or those price fluctuations on a laddered portfolio, you can build it out with CDs.
So we would own the ladder.
I'm sorry?
We own the ladder, the village, and so we just let these things roll off and schedule it according to when the money will be used.
Exactly. And that's really the nice component about this too, is that it's not going to be, you won't have to look at it and do the market to market kind of deal with, like we're looking at from the long-term portfolio. You can just ladder out a CD portfolio in this kind of short-term window, that 0 to 12-month term, when you guys are looking to spend down those bond proceeds. And again, Nikki will have a good idea of, when, well, first of all, when you need to spend the money by, and then second of all, how we're going to ladder out a portfolio for you as well. So again, taking advantage of every additional increase in rate that you can, but again, not overextending yourself and worrying about those price fluctuations.
And just the last one, rates are extraordinarily low. there are fees included, so we're not worried about, you know, a negative return in any way because of fees, would we? I mean, that's not a possibility, is it?
No, no. When we quote all of our rates to Nikki and to all of our clients, everything is net of fees. And right now, again, we're looking at, you know, we're waiving fees a lot across the board for all of our clients in these local government investment pools, and when we're purchasing fixed rate securities for them through our brokerage services, which is what this iPrime would fall under. So I mean, we're looking at usually fees within the 5 to 10 basis point range. I mean, they're really low. So yeah, I mean, we would never quote you anything, or I mean, anything like that's either not competitive in the market. We'll tell you to leave it liquid, or we would never quote you a negative rate or anything like that. No.
Okay.
And if I can, Chair Reed, just add something to one of your questions. The time frame is something that staff is working on. We wanted to introduce this product to the Finance Committee first, but I know our Public Works team is working on refining the capital project schedule that would go along with the bond referendum. And what we're trying to determine is what we will be recommending to the Finance Committee in terms of issuing all the bonds at once or laddering them over 2 issuances. We have approximately 3 years to spend the bond proceeds from the time that they are received. So our thought process in pairing with this product would be to time out the completion of those projects and when we anticipate the payments to be, obviously keeping that time frame fairly short and kind of a 3-year installment.
Okay.
I have a quick question. So effectively, I'm assuming we're paying PMA for the discretionary asset management of the portfolio that we just saw, the $5 million. And this would be using PMA as our discretionary advisor, then hiring themselves for a product that we're then paying a fee to PMA for, just to make sure I'm getting this correct from a transparency standpoint.
Yeah, no, I really want to make sure we differentiate between the 2 services. So anything that you invest as the village into iPrime would not be part of your separate account or managed by PMA. So there'll be no fees charged by PMA as your asset manager specific for the village. You know, so definitely no double charging, nothing like that. It's 2 kind of, think of it as 2 separate decisions. It just happens that we're the manager on both the separate account, which is what I was just talking about, and then the money market fund type product that Eric was describing.
Yeah, it makes sense. I mean, as long as the fees are comparable, that takes away any kind of conflict of interest. So thank you.
Yeah.
Are there any other questions?
Me.
Okay. All right. Well, thank you, Brian and Eric. Appreciate your time today.
Yes, thank you very much for having us, and everybody have a wonderful evening.
Thanks for having us. Good seeing everybody. Thank you.
Thank you.
Thank you.
Okay, so as a follow-up for that item, we will be bringing this back before you with a schedule for your consideration, along with the bond timetable.
And
So that'll come.
to add, Nikki, would be just what would be the potential returns on this? So what are the they're not the fees, the yields at the time.
Okay. No problem. We'll add that in. Okay. I'm going to share my screen again. We're in the home stretch here. Okay. So moving on to our last item on the agenda. Included in your packet is a memo about the American Rescue Act. So as I'm sure everyone is aware, on March 11th, President Biden signed the American Rescue Act into law to distribute relief funds to address the economic impacts of COVID-19. This is the 3rd relief bill, and the first of which that provides direct assistance in municipal funding. So the bill as a whole was about $1.9 trillion. And within that dollar amount was 65.1 billion in direct municipal funding allocations. Right now, we have an estimate from the Illinois Municipal League that anticipates Glencoe may see as much as $1 million from this bill. Again, these figures are still being refined. So as soon as we receive the distribution from the state, we'll obviously share that dollar with you. And the plan for distribution is to distribute 50% this year and 50% in 2022. Now, the federal Treasury has 30 days from the date that the bill was signed into law. So we're there to distribute these funds to each state. And then each state or large municipality, which we don't fall into that category, each state has another 60 days to distribute to municipalities. So it's still going to be another 2 months before we see this dollar amount distributed to us. However, understanding that we could see as much as $500,000 this year, $500,000 next year, we did want to start to open the dialogue with the Finance Committee about potential uses for these funds, because this was something that, obviously we did not anticipate when we adopted the budget. So included in the packet is an infographic that was prepared by Baker Tilly's, one of the audit firms, not necessarily local, I guess one of the audit firms in the area, talking through about how these funds were allocated to different purposes. Specifically for the municipal funds, there are a variety of funding uses that we can use this for. The first two are obviously directly related to the village's response to COVID-19, particularly in response to the public health emergency, and also those expenses related to performing essential work. We are also eligible to utilize these funds towards revenue losses that are caused by COVID-19. The hook there is that you do have to directly tie that revenue loss to COVID-19 and the impacts from the pandemic. And the year of measurement that would be used for that would be, we would compare from 2019 revenues to 2020. And then also, we are also eligible to use these investments towards water, sewer, or broadband infrastructure. And then lastly, if we wanted to implement some type of local assistance program. So understanding that the Rescue Act itself has provided a number of funds for social services, for school districts, the Bar and Restaurant Association. There are a number of small business loan programs and assistance programs that are included in this bill. Staff was looking through opportunities to recommend to the Finance Committee that we thought would benefit the community as a whole, not only our businesses, but also our residents. So one of the options that we wanted to bring forward to you was really kind of get your thoughts of how you would like to spend this money, but also considering in the context of the village's 10-year CIP, as we are coming off of a referendum bond issue, we do have the opportunity to use this funds towards capital programming that could potentially lessen the debt burden of the village in the long term. If we were to use this money towards water or sewer infrastructure, we would be able to pay cash for improvements that maybe we would have otherwise borrowed for. In turn, doing that, that would positively impact water and sewer rates, water and or sewer rates, depending on the recommendation, which would benefit all residents, all businesses across the board. So that was really the recommendation that we're putting forward before you, but I do want to open it up to the committee's thoughts and discussions. And Manager Corrali, I don't know if you have anything that you'd like to add to that as well.
Yeah, Nikki, I don't have a lot. I think you covered it. Really, in our conversations at the staff level, it's been how do we see perhaps a way for these dollars to impact the community as a whole. Nikki really focused on that. We have had some internal discussion about our water infrastructure needs. We know there is a significant amount of investment still necessary in our distribution system. And we're about 4.5 years into our rate plan that has been steadily increasing water rates. I think part of what we would anticipate is if resources from the American Rescue Act were utilized for water distribution infrastructure, that we would take a beat and utilize some time to reassess where we are with our water rate increases and make some determinations about whether some of those would be able to be reduced or some of those future increases deferred or delayed based off of kind of performance of the water fund with now a almost fully updated metering system that's giving us a lot more accurate data on water usage throughout the village. There are a number of components to this, and we would recommend that we look at all of those. I'm not sure if Nikki mentioned this. The other point related to these funds from the federal government is that we have to expend them by 2024. So it isn't an immediate need. It isn't like we have to have shovel-ready projects as soon as we get that cash in hand and begin to spend it. But it is a near-term need. And I think when we align that with our financing plan, with our CIP, the components that we have in place, it I think is a good idea for us to find a way to utilize these resources in a way that benefits the community overall, and still moves us in the direction that we need to move, which is to be regularly and steadily investing in our distribution system.
Well, from my perspective, I think with almost 24 million in water expenses coming, I think we will have plenty of opportunity to use this money. I guess the other categories, I don't really know how they work, where we already know what we're getting, but you have to tie it to something that's already happened and proving it. So it doesn't make a ton of sense to me. But aside from that, point 4 is we have lots of need. So $1 million extra would certainly be helpful. If we wanted to tie it to losses or some of these other things, just to rebuild reserves perhaps, but I think our reserve status is fine. So from my perspective, I think using the funds on water and sewer makes the most sense.
Yeah, I agree. I think it has the additional benefit of clarity in terms of our use. We don't have to prove anything. And in the end, well, not completely, but to some extent, if we have more money from the Rescue Act to spend on our infrastructure, we may be able to invest in something else later.
I agree entirely with Jonathan and Barbara's point of views on that.
Great. Thank you. Does anyone have any other questions on this topic?
I just wanted to add again that I think this gives us an excellent opportunity to use that money in a way that lets us say to all of our residents, we've used it in a way that directly benefits our residents by relieving them of the cost of that portion of the critical infrastructure that we would otherwise have to have bonded and taken money and taxes for them to pay.
Thank you, President Levin. So in terms of next steps, we will work at the staff level to bring forward some more detailed recommendations to you in terms of what this money could be spent on and how it can be rolled into our overall plan. Okay.
Good.
And with that, that completes my presentation.
Okay. Is there anything else that anyone wanted to talk about? Hearing nothing. Jordan, were there any comments during the meeting?
No, we did not receive any.
Thanks. Okay. Motion, looking for a motion to adjourn?
Okay, so moved.
Second.
Okay.
I'll do a roll call.
Yeah, you want to do a roll call?
Yep. Trustee Vree.
Yep.
Trustee Miller.
Yes.
Trustee Rubin.
Yes.
All right.
Okay. All right. Thanks, guys.